Welcome back. Today we're looking at a detailed analysis of Broadcom's upcoming earnings.
And it's a very focused cut. It's really building this high conviction case for a gap up.
All driven by the hunt for what it calls a mysterious fourth customer. So let's see how we can make this thesis as solid as possible.
Yeah, let's jump right in. Because as central argument, it needs to be bulletproof, especially when you're dealing with something this, speculative.
Okay, so the main catalyst here, the thing that supposedly gets the stock from around $412 to $450 plus,
Right.
is the confirmation of a new major ASIC partner. Could be Anthropic, could be this Apple Project Baltra rumor.
It's a great headline. It's exciting. But I do wonder if we fully consider the risk of making that the absolute foundation for the high-end target.
You think it's too fragile?
I think the reliance on unconfirmed speculation for that primary 450 plus projection, it just weakens the overall analytical foundation.
I see that. I mean, you're going for this big, dramatic gap-up moment. But what if the CEO, Hock Tan, he delivers a fantastic quarter, but is, strategically quiet about the new client?
Then the whole narrative just
Right.
collapses.
And that's the weakness. The report's aggressive gap-up prediction, that immediate jump to 435, maybe 450, it's almost entirely riding on confirming this secret client.
A single point of failure.
Exactly. If they give a vague confirmation or, worse, say nothing, the bull case is just compromised. It forces the whole analysis to live or die on a rumor. That is a dangerous place to be for a high-conviction call. Okay, so the analyst needs a firewall. How do we keep that high-impact narrative and the $450 target, but without making everything hinge on a single whisper?
The best suggestion here is to strengthen the core analysis. Make the beat on known metrics the primary driver for that initial target. Say $435.
I see.
Then, you position the speculative client news as the accelerant, the thing that gets you that final leg up to $450.
So the analysis succeeds on hard data first.
Exactly. It moves the argument from being speculation-dependent to speculation-accelerated. That's a much more resilient structure.
So let's talk about how to actually do that. How does the analyst prove $435 is justified before anyone even mentions a secret client?
Well, one concrete way is to break the move into two stages. First, you quantify the known drivers. You detail the growth rate you need from the known big three AI clients, Google, Meta, ByteDance, just to beat that $6.4 billion whisper number.
Okay.
And then you show how that beat justifies a move to $435, maybe based on historical valuation when similar companies hit that kind of growth.
So you're shifting the argument. It's not they might name a client, it's they're already seeing massive growth from these three, which justifies a re-rating to $435, period.
You've got it. That gives the initial price target real credibility. It stands on its own.
And then the second stage?
The second stage is the clean acceleration. The analysis should project a revenue or order size for the rumored clients, Anthropic, Project Baltra, whoever.
You quantify the rumor.
Yes, show exactly what marginal financial impact is needed to move the price that last $15 to $450. You could model it out, say, this new client represents an extra $500 million annual run rate in ASIC revenue, and here is why that justifies the final $15 move.
So you're telling the market, here's the floor based on what we know, and here is the exact analytically bounded premium for the potential announcement. It turns the speculation into a number.
It removes the dependency on the rumor for baseline success. It creates a layered argument that can survive even if the big reveal doesn't happen. The conviction has to come from the balance sheet, not just the rumor mill.
Okay, that makes a lot of sense. So if the upside is de-risked, what about the cost of that growth?
That is a great segue. Because the section on margins, it's framed as a positive right out of the gate. And I wonder if that's doing a disservice to the data.
You're talking about where it notes that custom AI chips, the XPUs, have lower margins than their legacy software. And that's expected to cause, what, a 70 basis point dip in gross margins?
Yeah, and the analysis immediately says, spend this as investing for growth. I get the impulse. You want to keep the story positive. But the analysis risks minimizing a legitimate financial metric by preemptively spinning it.
What's the real weakness there, though? I mean, a 70 BPS dip isn't a disaster, and investing for growth is the playbook for every AI company right now. Does the market really need to have its hand held on that?
It does, because the weakness is structural. By immediately telling you how to interpret it, you obscure the objective reality. And that reality is that lower margins are, strictly speaking, a drag on profitability.
Even if it's a good long-term move.
Even then, it can alienate a more sophisticated reader who expects to see the drawback assessed honestly before you give them the strategic reason. It kind of looks like you're trying to hide the pain.
So the solution isn't to kill the growth narrative, but to reorder it, to show you've done the work.
Precisely. The suggestion is to first present the full implication of the margin compression, objectively. Then you introduce the strategic counterpoint. You build trust by acknowledging the reality of the situation first.
So how do you do that? What kind of concrete examples can the analysts use to really detail the impact of that 70 basis point compression?
To make it actionable, you could compare the margin compression to historical periods or even to competitors. For instance, you specify the margin profile of the legacy software, say high 70s, and contrast it with the lower XPU margins.
Okay,
Then you can show the exact revenue split required to cause that 70 BPS decline. You quantify the revenue mix shift that's happening under the hood.
that's much stronger. It lets the reader weigh the cost versus the benefit themselves. And what about the timeline?
Yes, absolutely. You need to articulate the timeline. Detail when this investment in custom AI is expected to, mature. Maybe it's tied to the 2026 guidance. You could even set a minimum acceptable margin threshold during this investment phase.
Like a floor?
A floor. If margins dip below, say, 68%, that becomes a new bearish trigger. It contextualizes the whole discussion, and it makes the investing for growth story way more compelling because you've already acknowledged and quantified the risk.
It moves the analysis from just cheerleading to actual judgment. That transparency builds conviction.
It really does. So we've covered the upside and the costs. Now let's hit the final pillar, the downside, the bear case. The strength of any bull report is really measured by how seriously it takes the bear case.
And from my read, the risk section here is very brief. It basically just says, if they miss on AI guidance, support is at $390. That's it. It feels a little thin for a stock at these levels.
I completely agree. For a high-conviction call, you need a three-dimensional view of risk, not just an on-off switch. The downside risk assessment here is just underdeveloped. It lacks the rigor you need.
So what's the specific weakness? I mean, for a short-term trade, isn't defining a hard floor like $390 sometimes enough?
The weakness is that it's a simplistic binary outcome. A miss on guidance leads to a support level, but it doesn't explore why a miss might happen. And that's critical. A miss because of a supply chain hiccup is one thing. A miss because a competitor just stole a major contract is something else entirely. They're both misses, but they have wildly different implications. This analysis just lumps them into the same $390 bucket.
So the analyst can't really calibrate the risk. A drop to $390 could be a buying opportunity, or it could be a major red flag, and you wouldn't know the difference.
You wouldn't. So the suggestion is to seriously bolster the bear case. Articulate specific, actionable scenarios that could cause a miss, and then clearly define the technical significance of that $390 level.
Okay, let's brainstorm some of those scenarios. What are some plausible risks specific to Broadcom?
Well, one way to enhance this is to identify real counterarguments. You could detail the risk of competition, maybe nimble ASIC designers, or even in-house efforts from their big clients like Meta or Google.
That's a real threat.
Another one could be a broader slowdown in the semi-cycle, or a specific delay in a big project like Project Baltra, and you could show how that would directly impact the revenue pipeline.
That gives the risk profile real teeth. Okay, so now the second piece, justifying the $390 number. It can't just be a line on a chart.
That's right. You have to explain the technical context. The analysis should explicitly state that $390 represents the high end of that historical $350 to $380 consolidation box that was mentioned earlier in the report.
I remember seeing that.
It gives a support level specific analytical relevance. It's not just a random number, it's a proven area of demand from previous price action.
So by connecting $390 back to that consolidation zone, you're arguing for its significance.